Hey everyone, it's Ed Kime from over at Quantcha, and welcome to another day of the Quantcha Challenge. As always, we remind you to check out our unlimited commission-free stock and option trading offer for $99 a month, where you get a great trading experience through all the Quantcha tools, as well as that commission-free stock and option trading. So we're going to start off today by taking a look at the current state of our portfolio. We've been building it now for about 2 weeks. And at this point, it's a bit of a mixed day for us. Just kind of doing a quick checklist. We're bullish on Carnival, so seeing a Carnival decline doesn't help us, but it's also not substantial. It's a little bit down for our holdings. Thesis hasn't really changed on this. I feel pretty confident, and I'd like to say that I think that over the next 4 weeks, we'll probably see it stay above 55, get there and stay there. Microsoft, again, another one we're bullish on. This is a covered call position we have. We're looking to exit it probably on Friday altogether because we don't want to hold through earnings next week. That's now in red because we have gotten within 7 days of earnings. So that's a quick reminder for us from the tools. It's up today. That helps us. Micron, which we opened yesterday, we're bearish on Micron. They are having a kind of a mixed day. They've been down and up a little bit. We think that over the next over the next 4 weeks, I think it's going to see its way down. Ideally, we just want it to be on the other side of 34. So as long as it's below 34, we should be able to at least break even, hopefully make a bit of profit. I think that this guy has a bit more room to go down. And then finally, Exxon. Exxon again has been bouncing between 71 and 72 and a half or so since we opened it up 2 weeks ago. I think that's going to probably continue to be the case, but on the down days we just want to make sure that it goes down more, and on the up days it doesn't go up as much, and that's kind of what we're getting here. Taking a quick look at our Greeks for portfolio review, our beta weighted delta is really close to zero, so I'm happy about that. We don't want to take too much of a dependence on the market. Our gamma is getting a little bit bigger than we want. That negative 11 or so means that it's going to impact our delta a bit more as it moves around, but I'm not too worried. We can see that all of our trades have a positive delta, positive theta, except for the Micron one, which is right about zero. This generally means when you see positive thetas, it usually means that time's on your side for the trade, so that if you can just kind of wait it out, that you'll see a gradual increase in value over time. Of course, that's, if everything else kind of stays where it is, if your pricing and your volatility and interest and all that stuff stays where it is. But generally, we try to trade the credit spreads when we're going to do a directional trade. So we want to see, or in this case, credit. This is effectively a credit spread, owning the stock and selling the call. So we want to see positive theta just because we don't want to be pressured to see big movement. Vega, we're a little bit short on Vega, which just means that in the event that volatility rises, primarily because we're holding credit spreads, we'd see a little bit of a portfolio decline. And Rho, not too worried about it. The odds of interest going up a full percent and us losing that $1.62 is not front of mind right now. So as the quick review for the day on the portfolio, I don't think we're probably not gonna make any changes. Things are going along fine. We're up a little on the day, which is nice. I wanted to spend a little bit of time though and try to keep this as brief as possible, but we're going to make an earnings trade today, and we're going to trade something that either announces today after market or before market tomorrow. So we're basically going to target tonight's volatility change for some stock somewhere. And one of the great ways to do this is to just go off to the screeners. And we've got a ton of screeners here, all kinds of trades that you can go into. The one I spend most of my time in, though, is actually the stock screener. The stock screener is an option, it's an option-focused stock screener, meaning that when you go into the screener, most of the stuff we have here, we have a lot of fundamentals that you can take a look at, but we also have things like the volatility and liquidity ratings and where the options are available in terms of weekly or leap. We also have our crush rate, which is an important thing I'll talk about in a second. And one of the cool things is our calendar and trading days until earnings. This is the place we're going to focus on right now, because you can see we've got a ton of stocks that are available here. We're just going to go in and say, in this case, just 0 to 1 trading days until earnings. This 0 to 1 means that it's just going to be 1. I mean, we can make it 1 to 1, but this is saying that one trading day, which counts as today. And because the market's still open, it sees that as one trading day remaining. and so we're going to trade. And we can see there's a ton of options. In this case, there's 72 optionable stocks that will be whose will have a significant change in their outlook by the time the market opens tomorrow, and then we can kind of filter down a little bit. Now, because we're going to trade options, we're going to trade against volatility. We're going to try to isolate the change in volatility for the weekly options that exist this Friday and hedge them off against options for next Friday. We're going to do I guess you call it a double calendar or a double diagonal spread. But basically, we're going to come down here. We're going to make sure that the option liquidity is only great. We want to see only the stocks that have great option liquidity. In this case, it's three: American Airlines, TI, and Union Pacific. And actually, it's funny. There was one other stock I was looking at for tomorrow, and the volatility, rather the option liquidity, changes throughout the day. Because we bring that up with the latest data we can. And it's based on a whole combination of factors that include the option series that are available, whether they have weekly and leaps, and a lot of information around the 30-day options. I'm going to move this up and say only good and kind of go a little bit against my general rule of thumb because I'm trying to isolate into Granger, which was maybe actually mistaken here on the trading days remaining. Oop, wrong button. We're going to go to 2 trading days out here, if I can avoid the function keys. And I think, yeah, this was actually the stock I wanted to. It's marked as 2 trading days, which is, or actually, there we go, 1 trading day. They're announcing tomorrow. They actually do have they have good liquidity. They have weekly options, and they have leaps, which we don't really care too much about. But the thing I liked most about them is if we sort by the earnings crush rate, and we're going to sort increasing. They've got this earnings crush rate of 46 and change percent. This is an important metric that is a proprietary metric that we developed at Quantcha. And what this does is it tries to isolate the market's expectation for the drop in implied volatility for the at-the-money options for the immediate expiration following earnings. And I won't go too deep into it, but we have videos, by the way, for our option liquidity rating that are out there, and we also have it for our earnings crush rate. And so, long story short, if we dive into this particular stock, keeping in mind this 47%, so let's just round it off to 50%. What that means is that the market is currently pricing these options for this Friday, which are at 132 volatility, to be priced closer to 50% of what they're at, or a little bit less than that. So it's expected that these are going to drop to like 66%. Now, if we look at the long term, right, the implied volatility over the long term is 34% or 35%, and that's even with a slight bump for these 6-month options that are that are from the earnings that's going to happen between today and tomorrow. So we know that realistically, like, there might be some volatility retained, but it's almost surely not going to be at 60-something% tomorrow. So we're going to kind of place a bet here that's going to say that the volatility here is going to drop more than the market is pricing it at. And we can see here, we do a little bit of math for you here. We got the crush rate at that 47%. The post-earnings implied volatility is at 62%, right? Which is sort of like this, it's kind of a weighted average of what the volatility, if you were to go long term. And it's 62 because obviously there's a few of these that are real high, and then there's a bunch of them that are low. So it's sort of expected that post-earnings IV is around there, and the long-term mean, I'm sorry, this calculation here is saying what the current volatility would be at if you were to price in this crush rate. So ultimately, the market is pricing the weekly options to drop to about 62% implied volatility. We think it's going to be much lower because the long-term mean is 39%. And we think that's even a little bit high at this point because of the current earnings volatility that's priced into it, which means that we're looking at 229 or almost 230 basis points of earnings IV richness. That's our terminology here that's saying that we think that the implied volatility is that basically that the pricing is way too rich for these weekly options leading into earnings. And that's not just because this is positive. I mean, this can be a positive number that you can have that volatility, but the point of this number here is that when you see it really high, and this is really high, that's saying that, like, we expect that this would probably drop closer to 40% for the week. And so we're going to go ahead and we're going to trade against it. Now, one of the ways you could trade against it, because we're going to do a calendar trade, there's a few steps that are going to be involved. The first thing we're going to do is we're going to target our short-term trade, the thing we're going to sell. And I'm just going to go right to the option chain here because it's trading at around 297 and change. And I think there's the 297.50s here. So I'm going to open up a short straddle on this trade. And we're currently budgeted for just one trade. And it's okay because this, as you can see, there's a ton of margin that's going to be required because this is an uncovered trade. And so what we're going to do is we're going to take this uncovered trade and not worry too much about the details of it. We're just going to model it in the book that we have for Granger. In this case, we've got nothing there, which is not surprising. Now, I'm going to use the back button to go back to the trade we were just looking at. And what we want to do is we want to hedge both of these legs. And in this case, I want to take a look at this exact trade, but 1 week in the future, using the options from the first. So I'll select that from the drop down. And since those strikes are available, it's able to give me that exact trade. And now what I'm going to do is I'm going to invert the strategy. So for each of the sell legs, it's going to become a buy. Each of the buys will become a sell. So when I click to invert the strategy, I'm now looking at a long straddle. And as you can see, this long straddle with a neutral view is expecting a ton of movement to make any profit. So this trade in and of itself probably wouldn't be profitable, but we're going to use it to hedge off the other one. So when I model in the book and I say, all right, now we've got some existing positions, let me model this trade in the book, which means add it to whatever I've got sitting there. And now we get both. We've got all four positions. We've got our short straddle for this week and our long straddle for next week. It's currently got a quantity of 2 for each. We'll change that in a second, but we'll actually probably notch all this down. We'll bring this down to 1, this to 1, this will come down to 2, or 1 rather, and 1. So we'll just save that just because we want to really isolate the amount that we invest in making this trade. So this is what our P&L will look like if we open this trade, right? This very, very unlikely scenario of the stock not moving at all after earnings would be if we held through expiration, we'd look at a $2,300 gain from this trade. And if we were to hold it to expiration, we'd see that we'd break even right around the plus or minus 1 volatility movement. And so this is a big amount of movement too. Keep in mind that there's about 15% chance that the stock will go above this in the current pricing, and there's about a 15% chance it'll go below this. That's just the standard volatility math there when you have standard deviations. What we think though is it's more likely going to land somewhere in the middle between those. I don't anticipate the move that we would look at here, which would be, which would also be a 15% movement up, or in this case about a 13% movement down. So I know there's a lot of volatility, there's a lot of expectations, but we're going to kind of trade the volatility here. Now, again, I'm talking about the directional movement, but the reason I'm talking about directional movement is because the trade we're looking at here is trying to isolate the volatility here. Now, what we're doing is we're isolating the volatility. We're trying to keep our beta as close to 0 as we can. Our delta, because we're not trading direction, and we don't want to see big movement in the direction. Instead, what we want to see is an adjustment tomorrow when the market opens, where these options kind of come down to earth, and the volatility for the short-term options drops so much that we're able to profit off that relative to a much smaller drop from the volatility in the week after. And this is a pretty complex topic to go through, but the other thing that I want to point out here is even though this calendar trade we're looking at, we do have a positive vega here. And a positive vega tells you that based on the current pricing and the options math and all the theory behind it, that in the event that volatility were to rise for the underlying stock, that we would expect to see a positive gain in the holdings of our book here. But this is a good example of where we're trying to make money by going against what the option pricing is. Because this is the case here, we believe we have a bit of an edge because we think, and I think we're pretty confident in it, that we're going to see a much bigger drop from that front week options than we will from the back week in their volatility. And therefore, the outpacing it is actually a case where we are going against the market, which you really have to do in order to make money in options. We're going to go against the market here because we think that the pricing will work out in our favor once we go to settle this trade. Now, we're not really holding it trying to capitalize on this a short-term directional movement, and we're not even really saying that we're betting against it moving this far. Although that's what the P&L shows, is that we're betting against it. What we're really just doing is we're selling volatility to people who want it now, immediately for this earnings this week, and we're buying it from other people who are willing to hedge against their positions or do whatever they're doing for the back week. So the other nice thing about this trade is that the cost is only 370. I mean, that's not cheap, of course. That's a lot of money still. But the point is, we've been mostly trading with value between, between upwards of $500 for these specific name trades. The the thing about this is that even though it's 370, when we close this trade, we're guaranteed we're going to get a debit. We're going to get money back on the trade, because what's going to happen is that these options, no matter what, our longer dated options are going to be worth more than the shorter dated options. That's just the requirement. I mean, when you compare tomorrow's 297.5 on the 25th versus the 297 on the 1st, it's going to be, we're going to have more value in the one we're long than the one we're short. But the question is, will we have how much more, rather? Like, will it be substantially more, or will it be substantially less than what we paid for it? So even though we are going out for this 370, it's not going to end up at zero. The only theoretical way it would end up at zero is if it moved so far that these options, that a pair of the options were completely worthless, and the other pair of options were so deep in the money that the time value is negligible for the two of them. And it is possible that that happens. I mean, that's sort of the movement out here. But at this time, like I said, our pricing has shown us, and the earnings for us is showing us, that we don't think we're going to get that. The other thing I like, and just as a general rule of thumb, it doesn't necessarily apply around earnings, but when people like to trade neutral trades, I always try to keep my profit window at least to reach the one volatility mark one way or the other. So if you have a condor, I always try to at least break even here, if not further out. Same for butterflies. And so this is, in effect, a form of a calendar iron butterfly with the hedging, or a calendar straddle, I guess would be a better name for it. So that's that. Now, without much further ado, what I should do is I should go ahead and let's go to try to place this trade and see what we can get it in for. As you can see, the spread is actually becoming pretty substantial now. So that net debit, let me just preview this, because that seems pretty. We're unlikely to close it at this price, but let's just see. I'm trying to figure out if there's anything weird here, because this is obviously a huge amount of money. Yeah. Well, for 210, we'll see what we can get here, and then we'll start to nibble our way up if we need to. And we're going to obviously pay quite a bit in liquidity here, but what we're holding on to here is the hope that we can, when we close the trade out tomorrow, we're able to see, we actually got it for 210. So we just placed that position. So we got it at midpoint, which, like I said, it's a $200, it's basically a $200 bet. Don't worry too much about the pricing. We're going to be down immediately because of this liquidity stuff here. Because of the market pricing we use, it's not that substantial really. But if we come down to managing our book and we take a look at it, we should definitely see an improvement in the value that we have going into tomorrow. I think we're going to see a nice profit on this. This book is actually thrown off a little bit because the liquidity is so bad right now that our pricing and the value of our book is considered to be, even though we have a debit position, you can see we're looking at negative $30 here. So this is like, we basically lost $240 in the current pricing model. If we were to use midpoint or something else, this would be a much more attractive number. But we're going to have a little bit of faith going into tomorrow. Hope you come back and check out and see how things did. The main thing we're hoping for at this point, though, is just a movement of less than 12% between now and tomorrow, and we should be able to turn a profit, assuming we don't get bitten by the liquidity monster. But again, we don't have any other trades outstanding. Portfolio is in reasonable shape, and we are up on the day, which is nice. And so, I wanted to show we're working on this new allocation feature. This basically takes your current holdings and tries to help you understand, just visualize where you're at. So in this case, we've got about half of our holdings are in cash right now. We've got a little over 10,000 tied up in Microsoft, which is our 100 shares plus the short call. And then we've got the margin that for these credit trades. This is actually a debit position, and we got the margin for these trades. So just as a quick glance to see like, hey, where's my money invested? We are working on kind of making this a little more easy to use. There's not really a lot of prior art out there for us to model against. So as usual, when we go out to build these features, we're just trying to zero in on what's most useful for option investors. If you have any feedback on this, we really appreciate it. We're thinking about different ways of illustrating like where you're short on delta versus long on delta to just see like, or rather like theta. Like some of your trades are going to be, if you're short theta versus being long theta, which trades are subsidizing the other trades. Like if you're selling a credit spread here in order to pay for a debit spread there, just some way to visualize it, just to help option investors better understand their holdings. But as always, if you have any questions or feedback, please leave us a comment below or hit us up at hello@quantcha.com. And as always, good luck and good hunting.